Welcome to the Real Estate Investor Podcast. I'm your host, Gary Lipsky of Break of Day Capital. I talk to leading experts to discuss a wide range of subjects to educate investors on best-in-class practices to build legacy wealth and positively impact communities. Let's jump in. Hey everyone, welcome to another episode of the Real Estate Investor Podcast. I'm your host, Gary Lipsky with Break of Day Capital. Be sure to join our Facebook group, Asset Management Mastery, where we have a great community of thousands of like-minded individuals sharing resources and best practices. Hey everyone, we have launched the BODC Multifamily Impact Fund. Invest with a trusted operator with a track record of success. Our fund offers diversification, risk mitigation, tax benefits, and stringent acquisition criteria. If you'd like to learn more, head over to our website at breakofdaycapital.com.
Choosing the right insurance coverage for multifamily properties isn't that complicated if you know who to talk to. At the Garzella Group, we're uniquely qualified to help you navigate the range of policy choices you have, and we're committed to saving you 30% in the process. We do intensive market research and have nationwide relationships, so we can find coverage other insurance brokers simply can't. We should talk. Go to quotenow.biz and we'll start the conversation. Today on the podcast, we have my good friend, Feras Moussa. Feras is a serial entrepreneur with a tech background. He's the co-founder of Disrupt Equity, where they focus on large-scale apartment acquisitions. To date, Disrupt has acquired over 5,000 units and $800 million of assets under management, primarily throughout Georgia, Texas, and Florida. Thanks for joining us, Feras. Can you start by telling the listeners a little bit more about yourself and what you do?
Yeah, you bet. Thanks for having me, Gary. So, a little bit about myself. My background's software. So previously worked at Microsoft, came up that tech world and ended up getting into real estate, just really learning, how to invest as an investor myself, and then realize it's the things that I like. It's people's numbers and systems. And from that, Disrupt Equity was born. And as a company, we're very much deep involved in the tech side of things and figure out how can we operationalize and make things better. And that's where we started Disrupt Equity, and then that turned into creating our management company, Emerge Living, which does kind of the day-to-day operation for first and third-party management. And the rest is history. Like I said, it's been management's a very tough business, but it's an important part of the operation. And as a company, we're focused on continuing to push the needle and figure out where can we make improvements. And so,
absolutely. It's obviously been a tough couple of years for real estate investors, with interest rates higher and longer than anyone would have expected, soaring interest rates, flat rents. I think almost all of us believe that rents will be falling September. Maybe there's a chance in July, but this month we'll see. What do you foresee in the next couple of years? People have talked about the tsunami of debt coming due, but obviously we're not really seeing that. What are your thoughts?
Yeah, will rates fall? Yes, sometime in the next 12 months. Is it going to be much? I don't think it's going to be too much, right? And so you have to kind of plan accordingly. And so I do think the tsunami concept it's kind of happening as we speak. I had dinner a few weeks ago with one of the top lenders, and it was interesting to hear what they're talking about doing in terms of restructuring, right? And what lenders are willing to do and what are they not willing to do. And lenders don't want to take over deals, right? Most deals, they're not set up to operate and manage deals. And so instead, their preference is to work something out that's a win-win for everybody, right? Whether that's accruing some of the interest on the back end or whatever. And so I think for us in our portfolio, we're lucky that early on we bought pretty tight caps. And so I remember even a year and a half, 2 years ago, we were paying up for those caps. They were expensive, but those have paid dividends because rates continue to go up. And so as a operator or an investor, it's about mitigating risk. And so what can you do to mitigate risk? And yes, you may not have positive cash flow, right? I'd be lying if I said our portfolio is perfect. Everybody's having challenges. But I think the people that'll weather the storm are the people that identify the challenge early on and really put a plan in place and work towards the goal, right, to mitigate and kind of get out of it, regardless of what happens with rates. I think there's no one that I'm talking to is saying rates are going to go higher, right? Very few people, but it's about if rates stay the same, right, what happens, right? Don't bet on the fall, hope for the fall, but really bet on rates kind of staying where they are. And do you have enough reserves, enough cash flow to be able to weather that storm? So,
yeah, it's if rates don't fall significantly, we're definitely gonna see
we've already seen blood in the water, but man, there's going to be a whole heck of a lot of blood in the water over the next year or
we
so.
just closed on a deal a few weeks ago, and the sellers are taking like a $13-14 million haircut on that. Right, so we're buying on a $14 million discount from where they were. So some groups, kind of already moved. Some people just right, and again, people need to understand the life cycle of funds. Right, why would they sell at a loss? Well, if they already have a lot of wins, they'll sell one at a loss, and they still net positive, and they wind down. Right, sometimes they have rules and regulations they have to sell by certain times, and so some of them are kind of forced to do that, and then some people have been trying to eke by, hoping for the interest rate fall to give them some clarity, and that hasn't happened. And essentially judgment day is coming due, right?
So talk about, a lot of people haven't gone to that loan mod yet. They're kind of pushing it off. You talk me through the process of like negotiating it and creating like a win-win scenario with the lender.
Yeah, it's a good question. So, I'm not an expert in it. We haven't done it on our portfolio, but we've spoken to several people that have, and it's ultimately lenders have, you have to put yourself lender hat on, right? How do they operate and what do they look for? So you have to understand your lender. Do they CLO their portfolio or do they carry it on the balance sheet? Different, ways that the debt sits allows them to do different things around what can they be flexible. But from what I've seen, right, most lenders aren't going to take a loss, like saying, hey, if it's a $30 million loan, they're not going to say, well, we're going to call it a $26 million loan. Instead, right, what they're willing to do is be creative in how do you stop basically all the juice from a deal going towards interest payments, right? Right now, the problem is most of these deals, your note may have gone up $200,000 a month. You haven't grown revenue to offset it. So instead, just to service your note, you're losing $100,000. And so the lenders are basically looking at it, well, we could do two things. We can either foreclose on a deal or we can modify and restructure it to where we'll still make our nut, but we'll just make it over a longer period of time further down the road. And so what we've seen is just lenders that are willing to do a couple things, right? Some lenders that have a nice balance sheet might be willing to essentially refi it out into a perm on their balance sheet if they like the asset, if the asset can support some nominal thing, where as an owner, right, your 9% rate may go down to a 6 or 7. So, right, so that frees up that cash flow. More common, what we're seeing is them essentially splitting the loan into two parts and saying, great, this part you need to service the entire time, right? But it's a smaller amount. And then the other part you have to service on the back end whenever you go to make an exit, right? And so ultimately lenders are trying to hold on to value, saying, hey, this deal's appraised at $34 million. We have a $30 million loan, but we're still in the money for that $4 million, right? They still feel comfortable at their basis that if they did foreclose and they needed to exit it later, they still are. But they're trying to structure it to where the current owners can stay in the deal long enough. And a lot of times, right, they're getting the ownership to put new money in too. Right. So in return for this loan mod, you're going to improve my position by injecting new money into the deal, whether that be to go improve CapEx, operations, or reserves. But essentially, the lender is willing to be flexible in return for you essentially reducing risk out of their equation. So it's those kinds of things that from people we're talking to that they've been able to successfully do. Right. And you just have to figure out how far you can push it. It's a negotiation. Some things, they care about, some things they don't. And my advice to people is, go in with the things you genuinely care about. Right. And, push hard on those. Don't go in and ask for everything because you'll quickly get a lender that'll say no.
Yeah. And really know your numbers.
Absolutely. And, again, you got to put your lender hat on too, right? Look at it from their side. They're not just going to give you money. And so it's about really knowing what the ask is, saying, hey, I'm in the whole $30,000 a month. I need to free up $30,000 a month of interest payments to make it to where I'm at least cash neutral. So how do we restructure the loan to achieve that and then work backwards into that? So
before we hit record, you were talking to me about a new deal that you closed recently. And then right after you closed, you had an incident. Why don't you talk about this new deal and what happened?
I mean, like I said, with these deals, you never know what may happen, right? So it's a deal that should have closed the previous week. It ended up getting pushed a week and it closed. And roughly 18 hours later, we had a box truck at the property that essentially caught the power line and kept driving and broke the power pole in half, right? And so now all of a sudden, this property you're excited about has this crisis on it, right? Knocked out power for 120 units, which is unfortunate because now you have 120 units, which is probably 200 residents that are upset. They don't have power and you're the first one to blame. And so, it was a complete, how do I want to put it? It was definitely a lot of education of understanding whose responsibility that is, right? Because from our side, we were willing to spend the money. We didn't even know who to go to. Right. The electric companies, most of them will say, no, they don't have the equipment on hand. The power poles are out of stock in Houston. We had a tornado kind of situation that came in a month ago that knocked out a lot of electricity that got repaired. And it was just kind of a he said, she said between CenterPoint. And I don't know how much people know about in Texas, right? Your electricity is deregulated. So you have these different companies, but you have one company that actually owns all the lines. And so it was a lot of damage control, and it took 9 days, right, to get this power pole installed, operational, and connected to the grid, because you got one person responsible for installing it, one person is responsible for setting it up, the other person is responsible for connecting it. And so, yeah, it was complete pain, but we ended up getting through it and back online. And then it's unfortunate that we had a hurricane come in 5 days later that took it all back offline again for different situations. So
it's people don't understand when they buy a property and they think it could be passive, and there's just so many, like, it's whack-a-mole, things that pop up totally out of your control, but you've got to fix it right away, because there's press that are very negative about landowners, even if you're really care about your property and your residents, they want to put us in a negative light, unfortunately. And here we are spending all this money to fix it and have a solution. But
spend the money to fix it, give concessions to all the residents. We put up residents in hotels, and we did everything we needed to do, but press will still say, hey, these owners don't want to fix the property. It's like, no, we want to fix the power. Trust me, that's the right business decision to make, independent of is it the right moral decision to make, right? So it's interesting kind of, if it doesn't, how basically the press will spin what they want to spin. So
yeah, and certainly there's a small percentage of bad apartment owners, but most of us want, you treat your residents right, you treat your community right, you'll get paid back, so much more, because they're going to stay, they're going to do referrals, you're going to benefit, they're going to treat your property right than the ones that don't care about their property.
I completely agree. I mean, if you build a community, it makes the operations of the property much easier in the long run. So last thing you want is just to kind of have tenants that are constantly, cycled out, right? Where they don't care about the property, they're on to the next one versus a property that they love, they enjoy the manager, they have really cool events, they're friends with the neighbors, all those things, you get retention, and, it shows. I mean, you're going to pull up all the deals, and you pull up our easiest deals and our most challenging deals, right? The easiest ones are the ones that have the highest renewals. It's just kind of a no-brainer.
Absolutely. We'll go in a different direction. I know you host a very successful real estate conference called the Multifamily Investor Network Conference a few times a year, and you've got one scheduled for September 7th in Denver. Tell me a little bit about it. What could people expect from the speakers and the content?
Yeah, you bet. So Gary, I think you were at our first one that we hosted outside of Texas. What is it, 5 years ago, probably? And so, Multifamily Investor Network, and for us, it's a conference that we put kind of throughout the state. We try to do 3 a year, or the country, sorry, try to do 3 a year. And it's really about getting people exposure to multifamily, right? I tell people you don't come to the conference and leave an expert in anything, right? But you leave knowing all the things that you don't know, and really, get the exposure that you need so you can then go home, get educated, and make good decisions. So for us, it's about really getting really good panels, really good speakers, lots of great content, and most importantly, get people to network. Right. We all know your network is your net worth. There's a lot of truth to that statement, right? It sounds like it's a cliche, but it's about who you know, the relationships that you build, and then you can go do bigger, better things together. And so coming up September 7th in Denver, we're trying to pick a really nice place that time of year, and Denver's great in September. So I'll be out there, and then either before or after that, I'll definitely be in the mountains, hiking, checking out things, maybe go on a train ride. Who knows? So
Nice. Yeah, I'll be speaking there. I'm really excited. I've gone to a number of these, and I always make several new, contacts, even in vendor ideas. Just I'm always learning and meeting great people. So I highly recommend it, and very, very affordable conference to go to.
Absolutely. You never know who you may meet. I mean, I met my partner, Ben, at a meetup. So it's about getting out there, getting exposed, and talking to people.
Excellent. We'll put the links in the show notes for people to sign up. First, appreciate you coming on the show and adding a ton of value on multifamily real estate. Where can listeners find out more about you and your company?
Yeah, no, thanks for having me, Gary. And feel free to check out disruptequity.com, DISRUPT equity.com. So love to talk to you.
All right. Thanks for joining us. We'll be back with another informative episode on the Real Estate Investor Podcast.
To all of our listeners, thanks for joining us. And if you like this episode, please head over to iTunes or Stitcher and like, subscribe, and leave a review, as it will help us reach more people. And if you'd like to learn more about what we do at Break of Day Capital, head over to our website at breakofdaycapital.com and sign up for our newsletter and fill out our investor application. We'll talk to you next week.